What's up, homeowners? This is Alex. Welcome back to my channel. And in this video, I'm going to share with you some tips on how to save interest off of your mortgage. And if you're watching this video, you probably just got your first mortgage statement and you're thinking to yourself, why is my mortgage interest so freaking high? So by the end of this video, you guys will have practical tips on how to save money off of your mortgage or shaving off a couple years off of your mortgage. Now, my first tip is that if you truly can afford it and if you have money set aside, or if you're still young and you're making a good income, is to go ahead and choose a 15 years term versus a 30 years term. You're going to be able to pay off your mortgage so much faster. And I'll be showing you an example of how this works. Now let's take a look at an example here. Let's say we have a loan amount of 300,000 and loan term of 30 years term and an interest rate of 5%. All right, so let's take a look at the monthly payment here. That's going to be $1,610 per month. That's just the principal and interest, not including the property taxes and insurance. Okay, and we'll take a look at the amortization schedule right here. So over here, you can see that your first payment is going to be the worst of all. $1,250 of that is going towards your interest and only $360 towards your principal starting the first month. On the second month and on, you'll be a little bit better. You'll be paying a little bit less interest every single month and a little bit more towards your principal. And as you make more payments to the mortgage, it will get better and better. So if you look close to like the 30-year mark, then it will be mostly towards the principal payment and less towards the interest. That's just how the mortgage amortization works. So now take a look at how much of the total interest you would have paid if you went with a 30 years. I want you to remember this number here, $280,000 in total interest paid. Now, if we take a look at a 15 years term, and usually on a 15 years term, your interest rate will be a little bit better by about 0.5%. Now, your total interest paid is $113,000. compared to $280,000 on a 30 years fixed mortgage. So you're essentially saving yourself about $160,000 of interest. Now let's take a look at the breakdown here. It would have been the same actually if we change it back to 5%. You're actually going to be paying the same exact interest payment as if you were doing on 30 years because your interest is calculated based on the loan amount. But what's happening with a 15 years term is that you're paying a lot more towards the principal. So your total monthly payment for a 15 years, it's $2,372, which is $762 more per month compared to the 30 years mortgage. So that extra payment is all going towards your principal, and that allows you to pay down your principal much faster, number one. And number two is that it will also reduce the overall interest you paid because, again, interest is calculated based on your loan amount or the remaining balance. So the less you owe, the less interest you'll be charged too. Now, here's my recommendation. Even if you can afford the payment on a 15 years term, I would still recommend you to go with a 30 years. And here's why. With the 30 years term, you're going to have a much lower monthly payment. This is how much you're required to pay every single month. Now, with most mortgage companies out there, there's usually no prepayment penalties, meaning you can always make extra payments towards your principal every single month. So what you could do is, let's just say that we make an additional $762 per month, as if we're paying it like a 15 years. So see, you're still going to be paying off in exactly 15 years. And by doing this, you're still saving the same amount of interest. And let's just say that you cannot make a payment of 762. Let's say we bring it down to $500 per month. I just keep doing this. So if you pay an extra $500 towards your mortgage every month, you're going to pay off your mortgage in 18 years. which is not too bad. So here's my recommendation to you guys. Lock yourself in for a 30 years term, but be disciplined enough to make extra monthly payments to your mortgage so you can pay it down faster. Set a plan on how soon you want to pay off your mortgage. If you're going to be retiring in the next 15 years, plan your monthly payment as if you were paying a 15-year mortgage. So you're paying $762. And if you can't do that, do at least $600 per month. Because what you could do with this is so powerful. Again, the more you pay now, the less interest you're going to have to pay in the future. You want this number to go all the way down, and you want this principal to go up. And let's just say that you got your annual bonus at the end of the year. Don't go spend it all on luxuries, travel, cars, stupid stuff. Pay it towards your mortgage. Let's just say that you got $10,000 a year in annual bonus. If you just take half of that, $5,000 every January, that's your New Year resolution for you guys. I got it all figured out for you. And you know what the best thing is? You'll be able to finish your New Year resolution on the first month of the year. Isn't that great? All right, so that's going to pay off your mortgage in 12 years. Compared to 15 years, you just saved yourself another 3 years. So that's why I said early in the video that only do the 15 years term if you could truly afford it. But for most people, I would recommend going with the 30 years term. You just have to be disciplined to make those extra payments to your mortgage because a lot of things can happen within 30 years. You might lose your job, or if somebody had a hardship, or if there's medical bills, you have something to fall back on in case something do change. You're only obligated to pay $1,610 per month for a 30 years term compared to locking yourself in for a 15 years monthly payment of $2,300 something and being in default on your 15-year mortgage if something does happen. All right, now the second interest saving tip is this. So let's just say that you're not able to pay more towards your 30-year mortgage payment. This is one thing you have to do. So what happens here is that your payment is still going to be the same as $1,610, but you're just paying $805 every other week. So by just doing this, you're going to save yourself $51,492 in interest, and also you'll be paying off your mortgage in 25.2 years, which is shaving your mortgage for about 5 years. There's no reason you can't do this. Now, with biweekly payments, it may not be offered for every mortgage company out there. What you could do is to log into your online portal to set it up, or you might have to call the mortgage company to have them set it up for you. But most of the companies should have this option. So what is happening with the biweekly payment is that because there's 52 weeks in a year, that means in 1 year, you're paying a full 13 months of payments towards your mortgage. And not only that, because you're making your payments earlier, that is also another reason why it's saving you more money just going with a biweekly payment, because your interest is compounded daily. So again, the more you pay in advance, the less you pay overall. So this here is really an easy way. I recommend every homeowners to do this. It not only allows you to save years in your mortgage. By doing this, you will not feel any burden on you. It's really a powerful thing to do. It adds up over time. And now the third thing you guys can do is to go ahead and refinance whenever you see the interest rate falls. Now, you guys may have heard that if you guys can reduce your interest by 1%, then it makes sense to refinance. But that's not necessarily the case. Sometimes you'll even benefit from just 0.5% of reduction in your interest, depending on the loan amount or loan terms, or whether you're paying a PMI or not. You can always talk to a lender if the interest rate has dropped to see if it makes sense to refinance again. So one thing you want to be aware of during a refinance is that if you refinance for another 30 years term, you're going to be starting your clock over again, which I think if you're watching this video, your main goal is to save on interest. So what you should do is go with the 15 years term or a 20 years term. That way you get a little bit better of the interest. And at the same time, you're not going to set yourself back for another 30 years. And one last reminder is to always keep a good credit score. A credit score of 740 or better, it's going to go a long way. It's going to qualify you for the best mortgage rates when you're shopping for a mortgage. All right, so I hope this video helped you guys out. I'm a mortgage loan officer myself. Feel free to shoot me a message or comment down below. Thank you guys so much for watching and take care.